Imagine building serious, long-term wealth without constantly picking stocks, timing the market, or stressing over daily price swings. Sounds appealing, right? Today, we're diving into three powerful Vanguard ETFs that could help you grow your nest egg in 2026 and beyond. These funds are designed for investors who want simplicity, diversification, and consistent performance over time. And before we get started, make sure to smash that like button and subscribe to our channel for more investing insights that can help you take control of your financial future. Legendary investor Warren Buffett has famously said that you don't need to do extraordinary things to get extraordinary investing results. What he means is that disciplined, long-term investing in high-quality, low-cost funds can be just as powerful as picking individual stocks. This is where index fund pioneer Vanguard comes into play. Vanguard is known for offering some of the lowest expense ratios in the industry, which means more of your money stays invested and compounds over time. And when it comes to wealth building, compounding is your best friend. Let's start with the Vanguard Total Stock Market ETF, often seen as the backbone of a diversified portfolio. This fund is designed to mirror the performance of the entire U.S. stock market, from mega-cap tech giants to smaller growth companies. Instead of betting on a handful of stocks, you're essentially buying a slice of the entire market in one move. With an ultra-low expense ratio of around 0.03%, this ETF is built for efficiency. Historically, it has delivered long-term annualized returns of just over 9%. While there will always be ups and downs from year to year, the broader trend of the market has been upward over decades. For patient investors, this ETF offers simple, broad exposure and the potential to grow alongside the U.S. economy. Next up is the Vanguard Dividend Appreciation ETF, which focuses on companies with a strong history of growing their dividends over time. This is important because dividend growth can be a powerful driver of total returns. Instead of just chasing high yields today, this strategy prioritizes businesses that consistently increase payouts year after year. Some of its well-known holdings include Microsoft and Broadcom, both of which have strong cash flows and proven track records. With a low expense ratio of about 0.05%, this ETF blends income and growth in a balanced way. Historically, it has produced nearly 10% annualized returns, showing that dividend-focused investing doesn't have to mean sacrificing growth. The third ETF on our list is the Vanguard International High Dividend Yield ETF. Many investors concentrate heavily on U.S. stocks, but adding international exposure can help diversify risk and open the door to new opportunities. Right now, many international dividend-paying stocks are trading at attractive valuations compared to their U.S. counterparts. This ETF offers exposure to high-quality global companies, while also delivering a yield of around 3%. Some of its recognizable holdings include Nestle and Toyota. With an annualized return above 10% since its launch, this fund shows that international investing can play a meaningful role in long-term wealth creation. Now let's talk about what these numbers actually mean for you. When we look at the long-term performance of these three ETFs, we see an average return hovering close to 10% per year. Of course, no investment guarantees future results, and markets can be unpredictable in the short term. But historically, a well-diversified portfolio has rewarded investors who stay consistent and disciplined. Here's a powerful example. If you invested just $500 per month and earned an average annual return of around 10%, you could potentially build a portfolio worth over $1 million in about 30 years. That's not from hitting a lucky stock pick. That's from steady contributions, smart diversification, and letting compound growth do the heavy lifting. What makes these ETFs especially appealing is how hands-off they can be. You don't need to constantly rebalance individual stocks or analyze earnings reports every quarter. By holding a combination of total market exposure, dividend growth, and international income, you're creating a diversified portfolio that's designed to weather different market conditions. Whether the market is booming or facing temporary downturns, this balanced approach can help smooth out volatility and keep you focused on long-term goals. As we head into 2026 and beyond, building wealth doesn't have to be complicated. With the right mix of low-cost ETFs, a consistent investment plan, and a long-term mindset, you can put yourself on a strong financial path. Remember, investing success isn't about perfection, it's about persistence. So, if you're serious about growing your wealth, consider how these Vanguard ETFs might fit into your strategy. Stay disciplined and keep your eyes on the bigger picture. And if you found this breakdown helpful, don't forget to like this video, subscribe to the channel, and turn on notifications so you never miss an update on smart investing ideas.